Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through Ledger's secure chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, welcome back to another episode of Forward Guidance. And joining me today is Cem Karsan of Kai Volatility Advisors and Kai Wealth. We're recording this the morning after the big election that occurred, and there's nobody else I'd rather talk about this than with you, Cem. So it's an honor to have you on the show, and I'm happy to have you here.
Great to be here. Yeah, great day to talk about these things. Thanks for having me.
Yeah, no doubt about that. All right, so let's get right into it here. We are coming off the back of the election. It's looking like a red sweep. Trump has been nominated, or has won the election. I want to start off by honing in on the societal and cultural impacts first, and then we can dive into the market side of things. Because as many listeners of you know, you've talked a lot about this populism era that we're living in, and it feels like we're really just heading towards that in a pretty significant way with a full-on red sweep led by the charge of Trump. So first off, just want to ask you, what are your high-level takeaways, implications from that perspective of what we've seen in the last 24 hours?
Yeah, so if you look at the elections from the last populist period, right? If you start in really 1960, right, and you take it all the way to 1980, you look at that 20-year period. We had Kennedy, who was assassinated. Three years into his term, LBJ takes over, and on the sympathy of Kennedy's assassination, gets reelected, but then doesn't have a second term. Then Nixon gets elected, right? Does actually get a second term, but then guess what? Year in, scandal, gets kicked out of office. Ford takes over, doesn't get reelected. Carter gets elected, doesn't get reelected. And then finally, in 1980, we have Reagan and the beginning of a new era. I've talked a lot about the 60s, mid 60s to 82 period, right? Which this rhymes with. There's lots of reasons why it rhymes. Again, primarily populism, protectionism, and what drove increasing interest rates. But we've seen other periods like this. That's just the most recent, okay? Periods of populism are time when people are unhappy. They do not, it is, we have been taught since the 1980s that there is a huge benefit to being an incumbent, right? Because since then, guess what? Almost everyone has two terms. There are very few exceptions, right? Again, until 2020, right? We can talk about kind of what happened, 2024. So we can talk about what's happened since, but really that period until this next period, they could not be more different politically. One is a period of peace and prosperity and expansion, and people are broadly happy. There's a building this quiet, but broadly happy. And now there is a period of people being unhappy, and it's primarily a function of this inequality that's built over the previous period. So it is a disadvantage to be an incumbent, and I'll call it right now. Everybody wants Trump, but be careful what you wish for. Second you have Trump, you probably want something else. And that's just like we went from Trump to Biden, now back to Trump. Now there's going to be another, Trump is not the cause. He is not the solution. He is a symptom of a broader reality. We talked about this prior to Trump's rise. The reality is we're in a populist period, and what has happened is Trump realizes he's a brilliant marketer, and he was able to take the right. If you think about the genius of this, it's pretty amazing. The left, by definition, what is the left? The left, by definition, is always populism. It's socialism. It's this idea that we need to think about equality and structure of society. Whereas the right, by definition, is free market economics. It is trying to have small government and not do these things. And somehow right, Trump has managed to take the right and convince the populace that they are more left than the left. And it's brilliant. It's marketing at its very best. He has been able to tell people he's going to give them and tap into that emotional populism, right, and give them what they want. The rust. Think about his inauguration speech. The rusted out cities in Middle America. Can you think of a more populist kind of rhetoric? Now, that's rhetoric, much like Trump has been known to do throughout all his businesses in history. Whether you're a Trump supporter or not, this is not political. He's very good at telling people, this is what you want, I'm going to give you this. And then he may not give you that, right? He may give you something different. And in his last term, by the way, that may be better. Like, populism isn't necessarily the best economic solution always. But the truth of the matter is, he went, came into power last time around under a populist kind of mandate, and he passed tax cuts largely for corporations. And that was actually very free market. Like, he did a lot of very free market things. Now, he did increase tariffs and do some other populist things, but he largely did a lot of big, actually free market things as well, which is really not in line with that kind of speech. So it's interesting, amazing what he's been able to do. Again, Nixon, it kind of rhymes with Nixon in a lot of ways. Nixon was right and managed to take his party left and give a very populist kind of rhetoric. And so he is kind of a Nixon-like figure in a lot of ways. History rhymes. Nixon got reelected, but he got kicked out of office eventually. We'll see this time around what that means. But inflation actually reached its peak, during, or at least it really accelerated under Nixon. Nixon, ironically, was the one who did all the price, the less free market economic parts of policy. He did price freezes, right? Tied things to inflation, and eventually pulled us off of gold in order to deal with it, right? So there's a rhyming here. I feel pretty confident that Trump's going to do some things that are really counterintuitive to what people think, and he's largely willing to go and break things in this environment to achieve his goals, better or worse. So this is not a surprise. Again, the world was demanding something. Trump saw it, and he stepped into that fold. He's a vehicle for something much bigger than him, which is a vehicle for this populist movement, and actualizing some of those things. This will resolve itself in the next 10, 15 years, but there's a period of volatility and crisis broadly that we will be moving through. If you talk to people, I don't know if you have before, I encourage you to, that lived in the 60s and 70s, they felt that the world was being torn apart at the seams. They thought that we could not survive this period, but if you look back, that was a time of great change and an important time of growth. The silver lining for those who may not be so happy right now is that, guess what? The only way we pass laws and change things is through crisis, right? Crisis itself is, particularly in a democracy, a necessity to, getting unanimity and change. The founding fathers of America created a system that made it very hard to pass laws. They did that on purpose because they did not want the system to break, because they knew that it was easy to kind of to create, change, or break a system that otherwise, they didn't want corruption to enter the system. So we haven't had unanimity for 40 years because we've had Federal Reserve policy able to come and solve problems without any crisis resolution in Congress, without passing any laws along the way. But the Federal Reserve has been a bit of a box now because we have to deal with inequality. And here comes your crisis in the next 10 years. We'll see if it's in 1 or 2 or in 3 or 5. But that crisis will feel painful and difficult. Trump will be mixed up in it all. He's not the cause. He's a vehicle for it. And my guess is we're in a period of immense change for the world, and that good things will come out of this in the long run. We need this. I think in 1989, the Batman movie, the Joker says, this town needs an enema. Yeah, this town needs an enema. We're going to get one. This is going to be a painful period,
Yeah.
but it's going to lead to great positive change.
Yeah, yeah. It's interesting. You said in there that this wasn't a surprise to you, but when I look at more traditional media components like pollsters and just the broad based traditional media landscape, there was a lot of assumptions that this was going to be a really tight race, and that it wasn't a given for Trump. So it feels like when I listen to your framework, it makes perfect sense what just occurred. But when I listen to those traditional media components, they were totally offside here. Whereas it looks like this new age of media consumption, which is like betting markets, Polymarket was pretty much right on the dots here compared to pollsters. So what do you think they're missing? Like, is this just part of that change, and they're just not realizing the societal change that is occurring?
I think the problem with data models in general, whether it's pollsters or trading models or anything, is they're looking at 40 years of data. 40 years is forever, right? Who looks at data past 40 years? If you do, and you try and make claims like I am over 40 years, people are like, okay, yeah, sure. Well, it's different from the last 40 years. All right, guy. Like, it is. It's different. There are big long-term cycles. It doesn't mean it's different than the long-term history. The long-term history tells you a different story. People are so focused on what's happened 5 years, 10 years, 20 years. If you're investing, who looks at a track record longer than 20 years? Nobody. It doesn't, it seems ridiculous to people. But the world goes through major cycles as a function of generational change and shared experience. And the pendulum swings, and then it swings the other way. And when it does, you have dramatic changes in how worlds and markets and polls even operate. And I think that's the core problem. I think everybody who's working now with systems now has systems built on data that is very recent.
So I want to talk a bit about how markets are digesting this red sweep that we just had occur. So just to level set here, I'm looking at the US dollar index. It's up 1.6% today. Yields are absolutely soaring on the long end. How are you seeing markets digest, this news? And what do you think is the key driver? Is it just the somewhat of a surprise of a red sweep, and just, historically markets have not really liked, they preferred gridlock, generally speaking. So what do you think is the main component that markets are trying to digest here, and what are the implications of it?
If you look at the 60s and 70s, again, as a proxy, people, if you go look and say, what caused the inflation? If you type into Google right now, what caused the inflation in the 1960s and 70s, right? What caused it? You'll get three things unanimously across the board. That'll be highlighted. And there's academic research about it and everything. What are those things? They are fiscal spending, right? Global conflict, the Vietnam War in particular, and OPEC crisis, commodities and oil shortages. What people don't realize is all three of those things, and nobody really talks about that. There's no academic research connecting the three, are all caused by a much bigger thing, right? They're caused by populism. If you have populism, you get fiscal spending. That one's an easy one to think about, right? The Great Society program of the 60s from LBJ, that was a very populist set of policies, right? We talked, the race kind of issues and everything that came up in the 60s. That was about equality and populism and equal rights. Similar thing. That feeling of things are not working was a function of populism. But protectionism, this is key, is by definition connected to populism. You can't worry about your people. Populism is about my people, not the people of the world, right? We're not thinking about people in China when we're talking about populism, and the people in China are thinking about us when they're thinking about populism, right? It is about us, and we go from a world of cooperation, right? Free market economics is how do we make more money? We lower labor costs, we expand globalization, we create better and faster technologies, we grow market share. It's free market economics. It's the right. But equality, justice, these things are our people, and it's competitive. And when we throw up boundaries, we throw up walls, this is an animal thing, right? Territorialism begins. This is mine, this is yours. We get into global conflict. And so the Vietnam War, the growth of the Cold War, all of those are tied to that populist period, from that time. And the OPEC crisis is, again, people having resources, their resources, that they want to protect, and they want to flex their muscles to compete and to get something out of it. So we are in a time of global conflict. We're in a time of protectionism, nationalism, isolationism. Make America great again. That's isolationist. That's protectionist by definition. That's the whole thing. Tariffs, immigration policy. Again, Trump is the poster child. He's the vehicle of the zeitgeist, right? And so you can point to that period and say, oh, it was Nixon that drove this, or it was LBJ, or Kennedy didn't get us out of the Vietnam War. Like, no, they're all just vehicles of a much bigger thing that's happening. And so, so what's happening here? We are amidst an inflationary period, because protectionism and populism, we're not being more efficient. We're not letting free markets go ahead. We're not maximizing to mean outcomes in GDP. Mm-hmm. We're maximizing to median outcomes. Mm. How is the average person doing? And that is a very different approach to policy, and that is very inflationary. We've seen that throughout history. And again, if you look at markets and what they were seeing going into this, it's not just the sweep from Donald Trump. It's because the downside on these bets was so small relative to the potential upside. The downside is you have the status quo, which is already structurally inflationary, right? Maybe it pushes it down the road and makes it less, it doesn't happen right away, right? And it becomes it's a little slower. But if you look through that 60s and 70s periods, yes, you have periods which all of a sudden, like OPEC crisis that accelerated, or increases of activation in the Vietnam War, or Great Society program. But all of those things are accelerants to a trend that's in place. And so the reality is those are very convex opportunities, and it's hard to say exactly who's going to get voted and what's going to happen. I mean, you can predict and say you're not surprised by X, Y, and Z because they're likely to happen. But any number of things can happen that are going to follow this broader zeitgeist and the demand. People respond to incentives. Things happen in line with push and pull. What the general pressures are. So my point to you is, yes, the dollar is strong. Yes, interest rates are starting to accelerate on the longer end of the curve, and you're getting a steep curve, something we talked about for some time. But it's not just about Trump. Yes, it's about Trump accelerating. Think about COVID, right? COVID has created a lot of things that people originally pointed to and said COVID was the cause of work for home. It was the cause of inflation. It was this, that, and the other. But what it did is just accelerated things that were already, in place. So once we got there, now there's no going back, right? These are just accelerating trends. Anyway, so yeah, to speak to what we're seeing an acceleration of something that we saw start a little while ago. And if you think it's just a short-term thing, you're missing the big picture. It is an accelerant into what is a trend. Yes, there'll be pullbacks along the way. We didn't go from 3% in 10-year in 1966 to a 20% 10-year in 1982 in a straight line. We actually went from 3 to 6 to 3 to 10 to 5 to 15 to 10 to 20. That's how it went. That's what it looked like. And every time it came down, everybody was like, whoa, solved inflation. At least the first time around. Second time, like, well, it was better. Looks like we're getting back. Eventually, they lost control of the long end of the curve. The Fed was no longer able to control inflation, which they honestly can anyway. But over time, it's even harder because there's a lag to a lot of these effects. And once people start, and not just people, but markets start to capture on the idea that, okay, this is not over, right? This is a secular problem. Then what happens? Then there's a pulling forward of demand because people realize they need to build inventories because inflation is structural. One, two, anytime interest rates come down, there's a rush to borrow money to buy anything pinned down, which again accelerates inflation. So this thing is a circular, once it gets started, it's really hard to stop. It's actually impossible to stop because the underlying things that are causing it are political, are much more structural. So anyway, I don't know if I answered your question directly, but these are the things that we've been talking about for time, and to see them accelerate during this is not just a Trump reality; it's a societal reality. Trump is an accelerator.
Yeah, I mean, what I appreciate is that you're covering the high level themes, which I think is important because we can get caught up in just today's price action, but the fact is that you're really hitting home is that these are pretty secular trends that are starting to really begin to accelerate. One question I have for you is just I'm curious about your mental model for how to like quantify this secular inflation increase with the context of Trump's policies that he's proposed. So, for example, something I'm trying to figure out is okay, obviously, he wants to be the tariff man and bring in substantial tariffs. But on the other side of the equation, he's talking about drill, baby, drill, and just, trying to get as much oil supply as possible, being produced. So those sort of work against each other. More oil supply would probably be a boon in terms of like disinflationary impact. But then you got tariffs. So what's your high level mental model of how to try to quantify these different impacts?
Yeah, I really break it into two major impacts. One is the secular, piece, which is
Hmm.
completely devoid of whatever is happening in terms of cyclical business, right? Growth. That's why it's secular, right? We're not worrying about business cycle at all. And then the other one is, cyclical, right? What's happening in terms of stimulating from a cyclical perspective? What Trump is talking about doing is we are running broadly a demand push economy, right? And a demand push economy, when you do the fiscal policy like we saw in 2021, you get a cyclical boom, right? That much like monetary policy, they both will drive cyclical, liquidity, right, at the time of impact. One of them, monetary policy, does it in a way that fades quickly, right? But that structurally that is deflationary, right? Because you're getting, again, more globalization. A lot of the money moves out of the system. The velocity of that money is zero, right, in this economic system. The other one has a big impact, sticks around for a little longer. It's demand push economy, right? But then structurally is inflationary, right? When you put them both together, it is cyclically inflationary on steroids, right? And then instead of being deflationary on the back end, it is, it remains inflationary on top of that. So instead of if you were to just do monetary policy on full tilt and then do fiscal on full tilt, you will have a massive push. And then the short-term inflationary impact can be dramatic, right? The long term is already there with the fiscal. The other one is really pushing along. Now, you can argue, and I don't think this is wrong, we've never seen this, to be clear, but if you do both full tilt and you're the United States of America, now you can't do that, and you can't spend like crazy and just print more money, which is basically what we're doing on full tilt in Zimbabwe. You can't do it in Turkey. I'm from. We see Erdogan tried to do this. By the way, this is not the first, with great success for a short term. Now they're experiencing 80 to 100% inflation. It took a while, right? And the reason they didn't get more inflation earlier on is because they had the protection of really cheap interest rates globally, and kind of the deflationary pressures of all that. But you could argue the United States, with the exorbitant privilege of the U.S. dollar, as long as it can maintain the exorbitant privilege of the U.S. dollar, which again, that's pretty entrenched. I mean, it's not forever, that's for sure, but it's pretty entrenched. If it can, then it has the ability to do that. It has the ability to really tax the rest of the world, export a lot of the inflation that's caused by fiscal policy. And that is an America First policy in every way, and would be a boon in the short term for the United States economy. Now, in the short term, you heard me say in the short term, is that a year? Is that 5 years? Hard to say. The problem with that system is that you're taxing the rest of the world. Rome can grow by taxing the rest of its provinces for some time and generate great strength, and power amidst the way. But it's actually that it undermines the whole system, right? If you are not in some level fair to the rest of the world, at least provide some level of, not that fair, where it's ever truly fair, but allows some level of benefit to the rest of the world of the gains. Um, at some point, the rest of the world is going to kind of give you a big middle finger and team up against you. And there's already signs that that's in the works, right? China's not very happy. They've expressed it. They're teaming up with Russia. Russia's teaming up with Iran. We have a global conflict that is likely to continue to grow. The more isolationists and more we try and say, oh, okay, we are going to do it our way, deal with it. I think it's pretty clear what the incentives are on the other end. And if you want to continue to have the exorbitant privilege of the US dollar, you have to be a benevolent dictator, right? At least to some extent. And if you're not going to be benevolent, at least some semblance of a ruler that is going to allow the others to benefit as well, or to share in the benefits, the future is pretty ugly for the long-term strength of the United States and importantly, the exorbitant privilege of the U.S. dollar. The exorbitant privilege of the U.S. dollar is the U.S.'s strongest asset. Never mind the military, never mind the economy. Without the dollar, the strength of the dollar, the U.S. is just like any other country. Ultimately, I know a lot of people wouldn't like to hear that, but that's true. We were able, in a fiat world, it is an immense power. It's unlimited power. But again, we just saw the BRICS get together 2 weeks ago, and that if you were listening, there are a lot of people, a lot of countries that showed up there, a lot more than you'd expect, to shake Putin's hand, to shake Xi's hand, and to say, okay, yes, we agree, we need another way other than just king dollar. And so I think that's a real issue. And I think that's part of what Bitcoin's been telling you for some time now. I think that's what gold's telling you right now. In a world without that's continuing to see secular pressure against the U.S., not against the dollar itself, but the survival of the dollar. Now, that doesn't mean weak dollar, by the way. It actually usually means strong dollar until, because it's flight to quality until down the road. Now, I think we're 10, 20, 30 years at least away from that. Empires don't crumble overnight. But it is a dangerous long-term precedent to make, and we would, in my opinion, be borrowing from the future by doing that. I think that's what Trump or Trump is taking us, and I think it could be again very positive U.S., particularly relative to the rest of the world in the short term.
Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through its Ledger Secure Chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. Yeah, this idea that you bring forth of the absolute privilege of the dollars is so important because, if any other emerging market was running the deficits that the US was, there'd be some more strenuous concerns in terms of their bond demand. Obviously, there has been some, and we're seeing that today, the long bonds selling off pretty significantly. But I want to bring forth the context of the Fed. You've mentioned a couple times in the show already that they're boxed into a corner. There's some big issues that they're going to need to begin to tackle. I definitely wouldn't want to be Jerome Powell this morning trying to think about how to navigate this. But I want to ask you within this context, you'd mentioned earlier as well, this concern of potentially losing the long end and just how much control the Fed has there is, obviously we have the FOMC meeting tomorrow. They're probably going to cut 25. I don't think that's the major story occurring. I want to talk about the high level here. How do you think they're going to navigate this? Is the primary concern losing the long end of the bond market, or what do you think they're really thinking about here at this juncture?
I think you cannot separate politics from what the Federal Reserve does. I think everybody tries to talk about Federal Reserve independence. That's ridiculous. Like the Fed can't be independent. If it is doing the bidding of the United States, which it is, like this is not a they're not here to serve other countries, and is the central bank of the United States of America. And if they're doing the bidding in the United States, there is no way they can do their work without coordinating, or at least understanding what policymakers are going to do. And they can talk about how, well, not our responsibility. We don't talk to them. We're independent. But there is clear coordination going on. There has been from the beginning of time since the Federal Reserve was created. Again, I mentioned Nixon before. I think we all know Nixon's story and his connection to the Federal Reserve. These aren't coincidences. These are similar times. He was a Republican that was looking to do populist policy, but at the same time understood behind the scenes he needs to do more, still traditional Republican supply side economics to try and balance that and run a hot economy. Okay. Same exact situation. How do you do that? Because he's, boxed in, hard and passed policy, blah, blah, blah. How do you do that? Kicked out the Federal Reserve chief and he put Arthur Burns in charge. That's what Trump's going to do. It's everybody responds to incentive. He's somebody who wants power and control and wants to do what he wants to do. It's pretty clear he's not going to let anybody get in his way. He has the ability to kick out the Federal Reserve president and put somebody else in. And he will. He will. Now, is it going to be overnight? No. He's going to try and do it in a political way that seems more palatable? Sure. I mean, does the Federal Reserve have to, does that person have to get passed by Congress? Sure. But I would expect the thing that very few people are talking about seriously is big moves at the Federal Reserve early next year. I think it's going to happen way sooner than people realize. He has an ability, like when somebody comes in with all houses, which I assume at this point he's going to, right? And, the first thing is, okay, I have a mandate. I have the ability to get stuff done right now. And everything that he really needs to continue to have power and to continue to pull on these levers and have success for who knows how much longer with Donald Trump, he's going to go pull the handles of power and try and secure those right now. Federal Reserve is number one, most important, powerful lever he has the ability to pull, and he wants access to that. If he doesn't, he's not, he's not paying attention. And trust me, he is paying attention. Powell's job is, he's out of a job. I'll tell you that much. And somebody else is coming in who we don't know who it is, but it's going to be somebody who's very, very willing to work more directly with Trump and do his bidding. And that bidding is to run a very hot, try and push lower interest rates, try and push growth above, more importantly than inflation. That'll work great, on the short end of the curve, but inflation is going to be a problem eventually. And that'll ultimately be the undoing and the big issue we've been talking about for some time.
So maybe just like a tangible hypothetical around this is, it feels like, for the last 4 years, Treasury and Fed have been implicitly working together, but not explicitly. Do you feel like we might see some explicit moves where, I don't know, maybe the Fed starts like monetizing debt directly from Treasury, like direct issuance, not from the secondary market? Do you see those as like potential tail risks, or is it just too early to tell?
I don't think it matters if they do that or not, right? They can do it explicitly or implicitly. I think they're politically, their incentives are to not do it explicitly. I think it's amazing how few people will actually call QE money printing. And the second you say that, people are like, oh, no, it's not money printing, it's QE.
It's a swap.
Right? It's literally the same thing. And you just create a fake intermediary so they can exchange hands. It's literally printing money. And it doesn't matter if they're going to continue to put other names on it, try and obfuscate what they're doing. But one side's printing and the other one's spending. And the more spending we do, we need to print more. And, or in theory, like you should print more, you might as well if it's not going to affect the US dollar. And given the strength of the US dollar here and what we're seeing and the continued strength, it's a free lunch. Why do you think Japan, did what they did? We're going to do the same damn thing. That doesn't mean we are Japan. Let's not take that any further. It's a different story, right? Yeah. And part of the reason Japan could is because the U.S. said, okay, we stand behind you, Japan, as an ally and everything else. And so Japan was able to. we have the privilege of the U.S. dollar. We can buy as much debt as we can. People like talk about default. Oh, U.S. Default. Blah blah. We're not gonna default. We're just going to buy it all and make it go away, and then we're just going to shake hands. That's what Japan did. That's what we will do. So the debt doesn't matter as long as the dollar is not going to crash, and the dollar's not going to crash. So we will have higher. Japan was 275% of GDP, but it's nonsense because it's just the central bank just owned all of it. So it's zero.
Yeah.
So that's what we'll do, and yes, we will continue to do as much of that as we can, and I don't think that's necessarily wrong as the United States, but again, that is what will drive inflation abroad, right? Our ability to do that.
Totally. Okay, cool. So for the last leg of the show here, I want to shift gears into digging deep into some market structure dynamics, which you eloquently talk about. So, correct me if I'm wrong in just characterizing your perspective heading into the election and the rest of the year. But I believe you were looking at, implied vols were just significantly bid up across the entire vol surface. Looking at today, we're seeing the VIX is down, down to 16. The move is down significantly despite the huge move in bond yields. So maybe summarize what you were expecting into the move and then what we're seeing today, and if that's resounding with that framework, and where does that lead you for market structure dynamics for the rest of the year?
The reason we were able to so clearly say expect after, first of all, it started in the summer. We were expect incredibly slow, summer of George, absolute volatility crush, very low movement. And then starting in the fall, expect a 10% or so freak out because there's a lack of vol supply and skew, and the amount of hedging that would need to happen up there would cause something. And that was your chance to buy the dip because at the end of the year, we're going to make strong year. Okay, that was everything. We've been very clear. And by the way, the rally's not over. It doesn't mean that we're not going to get some potential pullbacks along the way if they come, right? But it does mean that the structural realities going into the end of the year and the flows that are tied to it, which by the way has nothing to do with anything we just talked about. All of the stuff we just talked about, which everybody thinks we're up 110 and we're going to rally and be strong because Trump got elected. No, very little to do with it. It has something to do with what's moving and how it's moving and acceleration in certain assets, and that we may run a faster, hotter economy next year, et cetera, like we talked about. But in the short term, the flows that are structural are dramatic. And what are those flows? Let's start from the beginning. December, the end of the year, is where the overwhelming majority of all structured product issuance, all hedging, all put buying, all skew is in the marketplace. Why? Because it's the end of the year, because everything gets issued for the end of the year. And not just that, a lot of these contracts are 2-year, 3-year contracts that roll forward, and that you don't have 2-3-year contracts for September. You don't have them for June, or if you do, there's almost no volume, right? Because people have their annual years tied to the end of the year. People pay taxes based on the year. The whole system is structured by the calendar year. So all of this supply and demand imbalance skew in the market, where the world buys puts to hedge their portfolio or sells calls against their portfolio. All of that structure in all of its forms tends to be, the overwhelming amount tends to be tied to the end of the year. On top of that, you have an election, which is in November, right before the end of the year. And all the hedging for that event has driven even higher amounts. This year, just a couple of important facts that people don't realize. The last 2 years, combined, we've seen structured product issuance go from $500 billion globally to $1 trillion per year.
Wow.
So we've had a doubling in 2 years of structured product issuance. The ETF business that's tied to options has gone from 25 billion 2 years ago to 175 billion. So you've seen another 150 billion increase just in ETFs tied to structured products. All of these, or the overwhelming majority of these, have one structure, which is short call or long put, or somehow hedging, portfolios, right? And again, or just selling yield broadly, right? What that does at the end of the day is it creates dealers being short put, long call, and mass. And we saw, not to mention, by the way, all of that issuance has created not just more volume that needs to be digested and warehoused by the market, but higher prices. Because the more supply and demand imbalance, the higher the pricing of that skew goes. So the skew was historically high going into the election, way higher than it's been in past elections. Even before the election, starting in August, when we had the crisis, not the crisis, the vol pop, that skew exploded because everybody was shorted. Everything else came down in front of it, and that stayed high. Okay, so all of that positioning means potential energy. It means that dealers are short because it's an easy trade to capture a lot of edge on a relative value basis as long as you manage that and warehouse that risk. But they need to be quick to buy back their delta, right? And to as their short puts decay, also get rid of the puts or things that they have against it, their reinsurance, other things they have against it. All of this structurally means the market, once that comes off the table, once the event is done, because the event happens, things expire, time moves forward, that you get charm, which is the moving forward of time, delta difference, and you have vana, which is the decrease in vol, effects on delta as well, and then all of that flow of delta comes back. We started seeing that 2 days before the election. That was the sign that they actually people are aware of this now. I've talked about it a lot. Other people are aware of these effects. People are out there. So rationally, it doesn't make sense. This was all very high, preparing for the election. Everybody was all ready. And then 2 days before the election, weird, they start crushing it, right? Because people see, and guess what? The market started percolating. People front running what they know is coming because dealers have this flow, banks have these flow. It's not human beings, it's actually banks and market makers who are sophisticated saying, okay, this is likely coming. I don't want to wait till the market's 100 points higher or 200 points higher to try and buy these deltas, right? I might as well take a little bit of a lean. And so it started happening, and that started kicking things off. And of course, we saw a good 2-day rally going into this. And again, the world just sees that as, oh, they're pricing in a Trump victory. No, it's very, very different than that. I know you can attribute some of that. I mean, but we've seen this again and again. At the end of the day, that is a major driver. And we've seen a decent chunk of that vol come out. We've seen a decent chunk of that skew come out, but skew is still relatively high in December and January. There's still more to come. The vol itself, again, these pushes can lead to a pullback. We will see some type of pullback because everybody is on the same side of the boat. People want to take profits. People were largely prepared for it, as we've talked about. This isn't a shock necessarily to the world. But again, the trend is still higher, and those flows are still very much there. So that's a major force. And again, I tie you back to these numbers. I said 500 billion structured products up to $1 trillion. 25 to 175. So the amount of positioning being digested is enormous, right? You've heard people talk about the JP Morgan hedged equity trade and pinning. That trade is $20 billion. To give you context, right? We're talking about 500 billion, right? They're talking about massive position. So that is a big part of this. Now, again, people are broadly more aware of these things. It was historic in size, so it's still massive flows, but you did have people preparing ahead of it. On top of that, and again, this is one I've talked a lot about. I think Andy Constant always asks me about this one. He's obsessed with this idea that I kind of presented. It was new to him when we talked about it, but I think he still questions it. But I think an important one is this re-leveraging effect, right? Which I cannot emphasize enough is also a critical part. It is not a coincidence that the last 2 weeks of the year and the first 2 weeks of the year, a full month, right, out of 12 months, almost 10% of the year, if you look at 125 years of history, not just 5 years, 10 years, 20 years, the full history dramatically outperforms any other period in history, right? Dramatically. It's like an 82% winning rate. The returns are something like a 1.5% for a month, right? It is dramatic. Everybody knows there's all kinds of, it's the Santa Claus effect. It's like, it's this January effect. People put names on it. Technical analysts realize it. But how many people talk about the why? Like people attribute magic to it. It's like it's in the Trader's Almanac. Like no, there's a reason. There's a reason it exists. Mm-hmm. It's not a coincidence. And the reason it exists primarily, again, these other the charm and Von effects, et cetera, which feed into it as well, right? But the biggest reason is because, generally speaking, the market is up in any given year, right? Why is the market generally up? Because companies make money over time. You have inflation. You have naturally structural factors that feed money into the system, and things go up over time, on average, not every year. And when the market is up, there is what's called a releveraging effect. What do I mean by that? If there is a $50 trillion U.S. market, which is what the amount of stocks are, the combined market cap of the U.S. market, and there's about 50 trillion of global equities, which are broadly tied to these U.S. equities in some form or another, and then you have another now $100 trillion of things tied to the U.S. market, whether it's private equity or other things, structured products. You have $200 trillion of assets. What happens when those assets are up 20% a year? What happens? You have $40 trillion, trillion with a T, more collateral. Now, to your average person, like, collateral, what does that mean? I just, my stocks just went up. Like, what do you mean I have more collateral? You can post those. I don't know who people do, but wealthy individuals, institutions, banks, they take that collateral and they can lend money against that collateral. The whole system is built on leverage, right? The Federal Reserve lends money to banks. Banks then can take that and then leverage that collateral to lend money. Mm-hmm. The majority of money, period, is not actual money. It's leverage. It's loans, right? And so the whole system is built on collateral. And so when you have $40 trillion of appreciation, you have 40% more assets. You have 40% more money. And if there was no leverage in the system, it wouldn't matter because there's nothing else to buy. But the whole system is built on leverage. So when collateral goes up, there's more lending against that collateral. There's more investment relative to the collateral. As a hedge fund manager, this hits home, right? Because if I'm non-correlated, and if I make, and there's embedded leverage in every hedge fund portfolio. If my assets go up 20% a year because I made 20%, guess what? My positions next year need to be 20% bigger. And so the whole way the whole system works is there's a releveraging effect. There's a reinvestment of the new collateral, which is a momentum effect which happens. Now, that 20% didn't just happen, just now, right? And that reinvestment for some strategies from banks, some things happens on a daily basis. Some happens on a monthly basis. Some happens on a quarterly basis, right? So importantly, right, it's not like you're getting this $40 trillion, I apologize, amount coming in Jan 1. But some portion of that 40 trillion, which is generally the slower, more lagging things, think private equity, which again has a ton of embedded leverage. Think bigger new funds coming on from the appreciation. All of these leverage pieces, which have a little bit of lag, that have longer duration, tend to happen on January 1st. Mm-hmm. Okay? And they happen again because, it's a new tax year. It's a new launch, right? It's now what portion? I have no freaking idea. Is it 5% of that money? Is it 10%? Right? If everything was monthly, be like 10%. More than that happens with Gen 1 for sure, right? And again, because gains tend to happen in OFDs, a lot of it's accelerated in a momentum effect. That's more short-term in that period too. But Jan 1, there is a significant reinvestment that happens in the market. And that reinvestment, Jan 1, people front run because they know it's coming. Add to that those Von and Charm effects I talk about. Again, the collapse of time because there's less holidays. There's more holidays and less time in the office. There's less relative volume to absorb the liquidity. And you get a chase. There's structural leans on this releveraging plus the Von and Charm combined, and particularly in a big up here. You're a fool to get in front of that.
Yeah. And
people know it. If you're underperforming, you better do it with leverage. You better try and get ahead of it. And so it becomes a self-fulfilling prophecy on top of it. Mm-hmm. But the point is, by the way, there's no free lunch, right? This is not like it's not 100%.
Yeah.
And by the way, the reason these are there to a great extent, because they're there, that means there's a fat tail. Because if something wins 82% of the time and everybody knows it's coming and the flows are there to support it and everybody's on one side of the boat, well, the tail is going to be really fat. And by the way, those puts that are out there, that extra open interest, if it ever activates, you're not going to be down 15%. You're going to be down 30%, right? And if you look at late 2018, I think that's an interesting story, right? That you saw some of that happen in 18 into Christmas and into the end of the year, right? But to be clear, that year we didn't have what we have now. It's a 20% up here, the massive structured product issuance, the bigger amount of open interest that drives that buyback. It is a bigger year than most, and these are the primary things that are driving into the end of the year. Now, just like anything, there's a give back once these flows are gone. It's not like these flows take you higher and then push you higher forever, right? These flows are there. They're structural. They bend longer term realities to an extent. And then there tends to be some type of give back. The second worst month of the year is February. That's not why February? Like, why is February bad? It's because December and January are so positive. And by the way, if you look if you look at it at February, it's not just Feb 1 to Feb, the end of Feb, it starts in the middle of January, right? Yeah. And there's a reason they talk about the January effect, which is the first 2 weeks. Because again, that reinvestment doesn't necessarily come in first of the year. It's like, okay, we need to set this money to work. We'll buy some on the first of the year, but we'll also maybe average it in over a week or over 2 weeks, right? Because we don't want to be all in on one day. So these flows come in. They tend to be very positive in the first several weeks. Once they dissipate, you also have like kind of on a chart for January. January is a big expiration as well. And then you tend to have a period of weakness, and particularly in up here, that's something to be watchful for. So we are circling calendars. We've done this before in 22. We were very almost called it to the day. In January, about 6-9 months out. But you should be prepared for that. The Wednesday or the Monday before January expiration into that Friday of January expiration should be a period to really take chips off the table and be hedged. Doesn't mean we're going to collapse per se. We'll see what happens, but that is when you start to really take those chips off and maybe even play short.
Cem, that was fascinating and a really great mechanical explanation of, I think, why you have the views that you do for the next few months here. Just as we wrap up, my final question is, based on the mechanical impact that you just provided, to simply put it is, bearish into early, first month of 2025 sounds like your assumption. And then second question is, I'm just super curious about like, this mechanical unwind of the event risk hedges that we've just seen. Like, is that complete now? We're seeing a huge VIX crush, or is that like a multi-week endeavor for those hedges to come unwound? And how does that tie into this mechanical impact that you just laid out for the next couple months?
You've seen the unwind of the event fall, which was some reasonable portion of what we talked about. On top of that, you've seen a decline in the extra premium that was in December 20th, some of the extra premium that was in December 20th and January, which was really there because of the contested election. And again, just the open interest that we've talked about and of structured products. So you have not seen all of it come out. The positioning is still very big back there in terms of, when I say back there, December and January. So those von and charm effects are still alive and well in December, January. Between now and December, those are going to be weaker now. So you kind of have this bump in the election, and then you have this bump in December and January. And December and January still, again, they come down, but there's still very much a lot of push there. Plus this end of the year reinvestment part I've talked about. All of that's still there. But this initial push, right, for the event fall is what you've seen. Okay. That is gone in terms of short-term push. Any remaining charm and vana for like the OPEX is relatively small and could, people are used to just being like, oh, it's a monthly expiration. You buy in this part, you sell, that part now is less strong. And I would say I would not feel comfortable leaning into, we're going to squeeze higher now. I think now it could happen, but I think that's not what the flows are going to be pushing at this moment.
Yeah.
I do think that as we approach Thanksgiving, in the holidays, and then get into December, we will see higher prices. And so I think we are likely to have a consolidation and digestion and have people lose some of their confidence. The calls that they've just had explode higher are going to have to kind of decay for a little bit again, and then we'll make another run. If it was just easy to go buy long dated calls and sit on them and make money, everybody would do it. And again, every time the calls I tell people like that you need to be in, they make a bunch of money and everybody then's like, oh wait, no, now they're losing money. Like why? Yeah, take your profits, reload onto a dip, like find your ways to digest the theta and the decay. There's a reason I'm saying long dated calls, right? But because there's a lot of decay to short dated stuff, there is a vague component. But I will say, importantly, vol has gotten cheap again, and particularly out of the money calls, long dated out of the money calls. You can own them again. We highlighted that there were 10 vol a month and a half ago. What did they do for a month? They just went higher, right? In terms of Vega. They got up to like 13, 14 vol, and guess what? They're right back to where they are now. Market's higher, right? So you got to benefit some of the benefits of Vega expansion before the election. You now got the rally, and but vol itself is cheap. So much better risk-adjusted returns to keep playing it this way. And the trend is higher. When it feels scary, you want to keep buying this dip. Not this dip, a dip. That's going to be, you have to have conviction when it pulls back, but you should have conviction given flows in your corner until early January. And that's nice.
Well said. Well, Cem, I can't thank you enough for joining us today on what I'm sure is a very, very busy day for you. So, really appreciate that. Where can folks go to find out more about what you do at Kai?
At KaiVolatility.com. We also have a wealth advisory, KaiWealth.com. Feel free to reach out through either of those channels. There's ways to request calls and talk to us. We have family hedge funds as well as a wealth advisory. And then you can find us on Twitter or X at jam_croissant. So just a play on my name. And again, we do a lot of media that you can subscribe to. Including a partnership with the CBOE, where we're doing a podcast going forward once a month, interviewing kind of big names in the volatility space. So tune into all that. Happy to be here. Thanks for having me. Appreciate it.
Awesome. Thanks, Jim.